I am joined by the global head of syndicate and capital markets at Credit Suisse, and also my very dear friend, Tommy Mercein. Now, Tommy,
yes.
We're coming off a first quarter, second biggest on record investment grade new issues. What's in store for the next quarter?
We think investment grade issuance is going to decline slightly. Usually the second quarter you have issuance go down by about 20% over the first quarter. Most issuers tend to front load a lot of their borrowing plans. But that said, we think given the combination of relatively low rates and where spreads have gone, that issuance is going to remain pretty robust.
Now, we hear from more and more investors, they're starting to get worried about rates rising. If we really do see that, are you going to see a slowdown? Are these corporations going to say, I'm not ready?
Actually, you know, you've had a lot of corporate treasurers and CFOs staring at low treasury rates for quite some time. And frequently, as you know, when rates start to come up, it scares people into the market. So on the first move, if they do go higher, I think you might actually see a rush to get financed on the fear that these rates could go away. However, my personal view is that's really not going to happen. There's not a big risk of rates going
Now, you're the guy who gets the phone call from these corporate treasurers. So when it was clear that rates were low and more investors are saying, I'm looking for yield, was it a mad rush to get to the new issue market? Did they just want to did everybody want to bring deals?
Frankly, it was more of a mad rush to buy the bonds. You know, issuers are pretty systematic in what they try to do and map out their strategies well in advance. That said, the combination of tighter spreads and rates staying low in the first quarter definitely accelerated borrowers' plans. But what we've really seen is a panic to get invested. And so the demand side has been very robust.
Who is buying the bonds? Because, again, every day we hear people want to be in the corporate market, people want to be in the high-yield market. Does that mean the group of investors have changed, or is it still the same old class?
No, it's the same guys. I think what happened in the second half of last year, you had a lot of insecurities about what might happen in Europe and what might happen in the broader markets. With some of the actions by the ECB, et cetera, those insecurities seem to have gone away. If people think the economy is getting a little better, there's actually a huge need to get invested from the traditional buyers of corporate bonds, which are asset managers, insurance companies, pension funds, and the like.
Do those asset managers, insurance companies want to be buying deals out of Europe? I mean, last year, Europe was clearly a no-fly zone. 2012 seems to be USA all the way. But are they saying, Tommy, I need to buy deals, there's not enough in the market, can you bring me something out of Europe?
Yeah, they really are. I think that with the European financial crisis being a little bit off the table as it relates to the liquidity issues over there, we've seen a number of borrowers in countries that didn't have a lot of access hit the markets. And frankly, because they offer incremental yield over where some of the safer credits trade, we've seen strong demand for that. We expect that to continue.
How about what sectors? Coming into second quarter, I know you can't give names. Are there certain sectors where we might see more deals come out of?
You know, not so much. I think you might see an increase in financial issuance as more borrowers that didn't expect to have access to the market have access to the market. So I think financial issuance, which is traditionally about half of our market, will remain strong. A lot of corporates sitting on a tremendous amount of cash and have, again, pre-funded a lot of their plans. So if the M&A calendar picks up, which we think it will, you'll see specific issuance on the back of the M&A calendar. But I think there'll be a steady flow of financial issuance, especially from issuers that are coming back up to investment grade that dip down into non-investment
Why
grade.
has the M&A space been so light? I mean, it was the big driver of 2011. Now, clearly the economy is improving. Do you think we're going to see a pickup?
Oh, absolutely. I think in the M&A space, there's normally a 3 to 6 month lag. And if you think about what CEOs and CFOs were facing in the fourth quarter of last year, there was a lot of uncertainty. That uncertainty seems to have lifted, so I expect the market will pick up again.
All right. Well, that's Tom Mercein. He's head of syndicate and capital markets over at Credit Suisse.